So, Patrick, here we are nearing the end of 2025, and I wanted to ask a question. What is a big frustration or something that we hear from people around the end of the year that is a missed opportunity?
So big thing is tax-wise, tax planning. Is there some moves I should make? Is there some financial planning things I should do? Something I should fund so I don't miss an opportunity?
Yeah, and I'll say there's a lot of CPAs out there that people look to for this type of advice, and unfortunately, a lot of them it's more rear view planning, and so there's a big missed window or missed opportunity, especially when it comes to year end, to take advantage of tax breaks that are available. And so, in today's video, we are going to go over 5 financial planning considerations to consider before year end, and know that we aim to be a resource. If any of these may make sense for you, we're happy to have a conversation and discuss how they may apply to your situation. So,
welcome to Cup of Bull, your go-to source for clear, straightforward conversations about personal finance and planning. We break down what matters so you can make informed decisions with confidence. Let's dive in.
With that, welcome to Cup of Bull. My name is Michael Dunham. With me today is Patrick Fontana, the founder of Fontana Financial Planning.
Cheers, Michael.
Cheers.
Welcome to Cup of Bull.
So, Patrick, to get us started here today, I want to hit on topic number 1. And as we go through these, one thing that I think will be helpful for us to make sure that we point out to the listeners is the timing. So some things have to be done by December 31st. There are some other options that are available up until the tax filing deadline. So we'll do our best to make note of those deadlines as we go through some of these planning considerations. Consideration number 1 is fund tax advantaged accounts. So can you talk a little bit about some of the tax advantaged accounts that are common for people to consider this time of year?
Absolutely. So when we look at end of year deadline type funding, the tax advantaged accounts, 401k through your payroll generally has to come during the year before the year is up to max out your Roth 401k or pre-tax 401k contributions, both 529 plans, HSAs, Roth conversions. Those are things you want to do before it's too late. There's a couple that you can do into next year, like SEP IRAs. You've got till the kind of filing deadline, and generally funding a IRA or Roth IRA, but not the conversions and not the stuff that comes through your paycheck.
Yeah, and one thing I'll add to all that is there are some options that you can pay just out of your checking account, your investment account. There are other options like a 401k, for example, that generally have to go through payroll. So at this point in the year, it may or may not be too late to do something like a 401k. But one thing that you could do for those other accounts that have to be funded through payroll is evaluate what is my opportunity for next year, right? If I am not on track to fully fund my 401k for 2025, but I know I have room in the budget to increase my contributions and try to hit that goal for next year, now is a great time to up those contributions and make sure that you're on track to do that.
Absolutely.
So the next planning opportunity to talk about is two-sided. So tax loss harvesting, which I'll say is a common thing that many people have heard of. Maybe not everybody's executed well, but it's a more common thing that people have heard of. And then the other side of that is tax gain harvesting for those that it's appropriate for. So can you talk a little bit about those two strategies and who each one of them makes sense for?
Sure. So when we look at a taxable investment account that, you've got holdings in there that have a gain or a loss, if there is anything at a loss and you can sell it and realize that loss before the year is up, you can even buy back that same name. You've got to wait for the wash sale rule, it's called, for 30 days before you go buy back the same name, or 31 days to be safe. The idea there is just to maximize how much you're going to minimize your tax bill by taking losses. On the reverse side of that, this thing we really love is tax gain harvesting. And so the idea there, I'll just siphon in on like a real specific group that this applies to. If you've got kids in college, they're about to graduate next year, say they're freshman, sophomore, junior in college, and they have an investment account with gains before they take their first big boy job and make real money, they're likely in the 0% long-term capital gains bracket, right? And that is ability to sell something at a gain and not pay any taxes. We've got a pretty big buffer even for just married couples that take the standard deduction. If the income is not above that limit, they can do the same thing, 0% or tax advantage wise, better than income tax, a kind of low tax bill. So before that window is up for college kids, and if you fall into that tax bracket as a married couple, taking a gain at 0% is awesome. You can reset the cost basis on those holdings.
The other strategy that I like to pair with that is when it's appropriate, if you're going to be gifting money. So for example, if you're going to be gifting $19,000 to your college age child who has this 0% capital gain opportunity, instead of gifting them $19,000 cash, gift them $19,000 of your most appreciated stock. They can turn around and sell it tax-free if they're under that limit. So they still get the $19,000. You avoided paying capital gains taxes on the growth of whatever investment that you gifted to them.
And we found that same thing fantastic for grandkids. And it doesn't have to be 19,000. That's the per person, gifting limit. But if you want to help your grandkid out who's in high school or college and has an investment account, or even if they don't have an investment account and you want to start one, that's a good way to fund it. Rather than giving them cash, say you take your highly appreciated stock, give that to them, then they can sell it, pay 0% taxes, and either use the money for expenses, paying for college, paying for their car, paying for things, or add to their investment account in their own name.
So the One Big Beautiful Bill Act was passed earlier this year. And with that was the tax bill that was passed. And so there was a number of big changes that will be occurring this year and next year as a part of that. One big thing for a lot of people to consider is their charitable giving strategy. So there's a couple big changes that are happening starting next year around the deductibility of charitable contributions that may impact the timing of when you want to make gifts and how you want to make gifts. And so two that I'll bring up, one that is going to, I'll say, impact more people is the ability to take a non-deductible $2,000 charitable contribution. So most people take the standard deduction these days. The standard deduction is quite high for a married couple under 65. It's $31,500 this year. So most people are not itemizing their deductions. And what that means is when they give to charity, they're typically getting no tax break for doing that. And so this change allows those people, if they give money directly to a charity starting in 2026, they'll be able to deduct up to $2,000 worth of that charitable.
So give me an example. Typical folks that write a small check to a charity for, say, $500 or $1,000, and we're taking the standard deduction in the past, didn't benefit them tax-wise. Next year, 2026, they make that same $1,000 check. It'll actually benefit them, but it's limited to $2,000.
Yes. And one idea I'll bring up based on your scenario is if they haven't given their $25,000 gift, maybe we make that on January 1. Instead of giving it in December, let's give it in January, and that way you get the full 2,000 as opposed to just 1,000. So that's where it can be good to consider the timing of your gifts to make sure you're getting the biggest tax break. The other change when it comes to charitable deductions, and I'll say this is more applicable for people who are giving big money, is they're introducing what's called an AGI hurdle before you get a tax deduction on charity of 0.5%. So really what this means is if you're giving a lot of money, there's this hurdle that you'll have to eclipse before you start getting a tax break that may impact the deductibility of the contribution, versus if you do it this year, you don't need to worry about the hurdle. So it's situation specific, but it's something to be aware of if large charitable contributions and large income are part of your tax situation.
So if your income is quite high, that's where that hurdle becomes in effect. You really need to give quite a bit more to hit the number.
Exactly. Yep.
Okay. Number 4, Roth conversions. When does it make sense to be looking at doing something? Here we are, late in the year. If you haven't made a plan for this, when's it too late? And who does this apply to?
Yeah, so Roth conversions are one of the tax planning moves that do have to be done by year end, by December 31st. And one warning I would give is there's a lot of people who wait until the end of the year, and the firms tend to get overwhelmed. So I'm a big fan of trying to get it done by early December at the very latest, so that you don't have to worry about your Roth conversion getting processed in time. But what our process is for each of our clients that we're doing these Roth conversions, and I'll say not always the case, but a lot of times it's somebody who has stopped working, their income's dropped, maybe they have a large investment account that they're living off of, where we're able to like artificially lower their income tax rate for a period of time. And what we do with those people is we review their tax return to look for the opportunity of how much could we intentionally realize income at an attractive rate and make that money tax free forever. So we're reviewing the tax return and then following up to figure out what is the optimal number given their situation.
So paint a picture for me. I know you came up with a term that was, kind of the avatar for the perfect, who's the perfect one that this applies to. They're at a certain age or a certain thing. They've stopped working. They're not taking Social Security. They're not taking required distributions. Paint the picture of who this is great for.
Yeah. So we call it the retirement tax planning window. So you stop working, your income drops to a lower level than what you've been used to. And it stays artificially low until I call them forced income events.
So say you're 60, 62.
Yep, exactly. 62, retiree, income's low. You've got a taxable investment account that if you need money every month, you're able to take money from that and tax efficiently access capital to pay your bills. And you haven't had these forced income events happen like Social Security, required distributions, these things that'll happen later in life that'll artificially increase your income a lot of times much higher than what you need. And that's the goal, is if we can intentionally pay taxes at a lower rate now, then these higher rates are going to be forced up into later on.
And those cases where we see the big tax bill coming, we see a big IRA that is going to have big required distributions. If we can head off that ship by doing some of these small, inexpensive conversions, we really get ahead of the game.
Exactly. And then the last thing that we'll hit on is just understanding the new tax bill. And I'll say the new tax bill is quite large. There's a lot of changes. And so it wouldn't be possible for us to go through all of them right now, but that's where having a good financial planner in your corner who really understands not only your situation and your goals, but also reviews your tax return, knows what your estate plan says, knows all of the key ingredients to your situation, and is also in tune with what these tax law changes are.
So give them the one applicable piece from there that we picked out. That's just the senior part. Who's the seniors that qualify, and what is it that's new?
Yeah. So it's called the senior deduction. And so this stemmed from the idea of no tax on Social Security. So in reality, what that looks like inside of the tax bill is anybody age 65 or older that's below a modified adjusted gross income threshold of $150,000 for a married couple. And that's up to $250,000.
So it's phased out of that income.
Mm-hmm, yep. Exactly. So for those people, you get $6,000 per person. So a married couple under that threshold gets an additional $12,000 on top of their standard deduction and their senior additional standard deduction. So in excess of $43,000 of deductions just for being above that age. And
so you're stacking the 12,000 on top of the 31,500. That's where that number came from.
Yep.
So this extra 12,000, we're talking about significant money that is essentially in that person's pocket.
Yes.
Excellent.
That is exactly correct. So thank you so much for joining us on today's episode of Cuppable. If you found anything we talked about helpful and would like to talk about your specific situation, we do have a link down below in the show notes where we'd be happy to have a introductory call with you to hear more. With that said, Patrick, how do you want to wrap us up today?
Well, seeing as how the year is up December 31st and it's kind of comes this way every year, I'm going to say rebalance before the end of the year.
Cheers.